tech issues on our hands, not the CrowdStrike kind. We've got the index kind. Tesla's down 11% right now. Alphabet's better than it was earlier, now down about $6.80, but stocks are at the lows of the morning here, and Angelo Zino's with us alongside Tom White here as we assess a few of the big tech numbers. I guess a little AI fatigue here, Angelo, not big enough output for all the investment, particularly at Alphabet?
Yeah, I mean, not necessarily a surprise in terms of, the reaction that we're seeing in the stock price here, given the run that it's had here in the first half of the year. But maybe to your point, I mean, this was it was a good quarter. I mean, I don't think there was anything necessarily wrong with the quarter, but investments continue to be fairly elevated. I mean, in terms of their outlook for Q3, they are kind of indicating higher expenses, partly due to higher depreciation expenses, partly due to investments on the hardware side of things. But nonetheless, I mean, maybe to your point, kind of some of that AI monetization, to no one's surprise, is not necessarily kind of flowing through as maybe fast as maybe some out there would have anticipated. But nonetheless, I mean, you look across their three key segments in terms of search growing about 14%. We think that was a really good number. Cloud growing faster than we anticipated and actually accelerating from Q1, growing 29%, and should bode well for some of the other cloud plays out there. And then on the YouTube side of things, a slight disappointment relative to expectations, largely clearly due to some of the more difficult comps that will likely also continue to be an issue as we go into the second half of the year. So maybe that's why investors are slightly selling off on it. But that said, we continue to like the story here, especially on this pullback.
Okay. And Angelo, the thing it seems is, you have a choice here what type of AI exposure you get. You can go for like big growth, and you're going to have to pay a much higher valuation, whereas Alphabet, one of the cheapest of the Mag 7. But the catch to me still is that with no growth, S&P, you're getting more growth than the index for a slightly lower multiple. And I feel like that hurts a little bit of Alphabet's case, because it's like, all right, well, maybe I just wait until they start growing again and I just stick with the index.
Yeah, I mean, I think that's a fair point. What I would say about Alphabet here is, and maybe even big tech overall. I mean, what we've been telling investors out there is expect a correction out within the kind of the tech space. I mean, I think we've seen peak to trough about a 7% pullback within some of the indexes we look within tech, and you've seen about a 2x decline or about 12% decline peak to trough in terms of semiconductor type names out there, which is now the biggest component within tech. But as far as Alphabet is concerned, when we kind of look out towards 2026, we're looking at multiple, maybe to your point, about 18 times, actually less than 18 times on a net cash basis. And we think they are executing extremely well. We even think the margin, expansion story is underappreciated as we kind of go into 2025 and 2026. So
that's a good point.
The earnings growth is going to be there here over the next 2 years or so. But we're going to see this digestion, we think, here over the next 3 to 4 months. And maybe that kind of supports the rotation theory out there.
It's a really good point that Alphabet's best quality right now is the earnings growth. Even if there's not revenue growth on the top line for the next couple of quarters, earnings are really jamming. So does that imply, Angelo, that you think that the valuation is going to come down in a good way? They're going to earn their way out of the valuation? Because 18s, if you're saying 18, that's a little lower than where it is right now, right?
Yep. So 18 on a 26 basis is where it's trading at right now, and clearly this is going to be all of big tech. We think where you kind of grow into that multiple, right? So and it's typically what you see at these point in the cycles. Also, especially on the semi side of things, I'd say also you kind of grow into that multiple where the earnings growth will outpace that of the actual stock appreciation here over the next 12 months or so. That doesn't necessarily mean you have to run away from these names, but what it does mean is expect kind of lower returns, at least within your stock portfolio, on those type of names.
Fair enough. Okay, stick with this because I do want to ask you about Texas Instruments. Tom, how do you want to trade this? I know you got a bullish trade.
Yeah, given some duration on this, maybe a little bit of time for it to recover. Implied volatility levels crushed even though the stock's fallen today. So directional biased here, using the option market, where I can offset some of my costs on a bullish play here, going out to the September monthly cycle. So 58 days to expiration. You got a couple months in this one for it to recover back to levels that we just saw ahead of earnings just yesterday. So buying the 170 strike call, slightly in the money by about $4, and then selling the 185 strike call. Because it's a 2-month trade instead of maybe a 12-month trade, you're lowering your expectations as far as gains go, but still taking advantage of some upside. Paying roughly, I've got about a 630 debit on my risk profile here, but it's trading closer to $7 right now because the stock has recovered from those earlier losses. But the debit you pay is going to be your risk. Now, if you pay 630, you break even 176.30 to the upside over the next 2 months. That's about 2% above the current share price. So you don't need a massive move to the upside. Now, your gains are capped above 185. But if you look at that on a percentage basis over the next 58 days, what you want is a slow creep higher towards that 185 level over the next 58 days.
Okay. All right. Makes sense. Get the call spread. Look for the stock to continue a little grind back.
Yeah.
It's trying to a little bit here, closer to 175. Texas Instruments. Angelo, I mean, this looked like a really good report. Shares are doing okay, but man, like a pretty solid outlook, right?
Yeah, it was solid. I mean, especially after NXP reported, a day earlier. I think there was some fear kind of out there that some of these analog companies would kind of guide well below, where the street was at. And when you actually look at where the guidance was for Texas Instruments, it was solid nonetheless. I mean, you can look at Texas Instruments. I mean, from their peak quarterly run rate in mid-2022 to the trough in Q1 of 2024, their orders had declined revenue had declined about 30%. On a quarterly run rate. So there's a lot of room for them to kind of make up some ground here over the next kind of 6 to 8 quarters. So we're kind of starting to, we're pricing in terms of some of those multiples right now, kind of trough fundamentals. And it looks like, at least from the guide here in the second half of this year, or at least for Q3, it does imply that we're starting to see improving kind of order flow within kind of their industrial and automotive markets. And that's about 2/3 of their revenue. That's what investors really care about, is kind of the recovery on that side.
Got it. All right. Good stuff. Great perspective. Thank you very much, Angelo.
Yep. Thanks for having me.
Absolutely. Tom, give me a trade.
Yeah, a little bit more cautious. It's fallen off of those, pre-market highs that we've seen, but still taking a neutral to bullish stance in here. You leveraging that option market, right? Implied volatility levels while they've fallen. Still giving myself a little bit of cushion here to the downside. So I went out to the August monthly cycle. And this is a strategy you can use over and over again if you think stock's going to stay above a specific strike. So went out to the August monthly cycle, so 23 days till expiration. And I just looked at selling a cash secured put here. I used the 195 strike put out of the money to the downside. You're collecting roughly about a $3.40 credit on it. The credit you collect is what your profitability can be on this one. But if you collect a $3.40 credit, selling an out of the money 195 put, takes your break even down to 191.60 over the next 23 days. It's about 4% below the current share price. So if you think that Texas Instruments is going to go higher or consolidate, or maybe it drifts a little bit lower but remains above 195, this strategy works out. And this is, like I said, this is one of those strategies you can look at and say, hey, okay, I'm comfortable owning the shares if it goes below 195 at that 191.60 break even.
Okay.
But at the same time, if it doesn't go lower, hey, I just get to keep that option premium I collected.
I like this approach for TXN because it was the kind of laggard for a while, still behind the group on the year, but a steady grind. And I think these numbers were real stable, and they're not super AI dependent really at all. So
yeah, they were on the automotive industrial.
Right.
And at the same time, the stock's not immune if the overall market continues to sell off. We got a lot of big tech earnings coming up in the next couple of weeks. That'll impact Texas also.
Okay. All right. Thanks, Tom, for the trades. Appreciate it.